Welcome. I'm Frank Holsteen, Managing Director of Wespath's investment management team, the team that oversees Wespath's investment funds. Today I'm pleased to be with you to talk about the highlights from the third quarter. There's been a great deal of change and upheaval in the world since I spoke to you to recap the second quarter. Back in July, President Joe Biden dropped out of the presidential race and endorsed Vice President Kamala Harris. There were also assassination attempts on former President Donald Trump in July and September, and the wars in Ukraine and the Middle East persist. In spite of everything, stocks and bonds both shrugged off concerns and turned in a good quarter. The S&P 500 index, which tracks the performance of the 500 largest companies in the U.S. stock market, returned 5.9% in the third quarter. Stocks of smaller companies returned 9.3%, as measured by the Russell 2000 index. The tech-heavy NASDAQ index posted a gain of 2.8%. Bonds were also up for the quarter. Bond yields fell in anticipation of a Federal Reserve interest rate cut, and as I've said before, when yields go down, prices go up. The Bloomberg Aggregate Bond Index was up 5.2% in the third quarter. The U.S. Fed did indeed cut its key interest rate by 0.5 percentage point in September. It was the Fed's first rate cut since the pandemic, and it may explain much of the investor optimism that drove stock prices higher. As a quick reminder, the Fed began aggressively raising interest rates in 2022 in an attempt to slow the rapid increase in the pace of inflation. Now, the Fed finds itself in a situation that some economists compare to Goldilocks and the Three Bears, not too hot and not too cold. If the Fed cuts rates rapidly, it runs the risk that the lower borrowing costs could overheat the economy, and then we could find ourselves right back where we started with too much inflation. If the Fed cuts rates slowly, there's a different risk. It's possible the labor market could cool off, unemployment rise, and the economy go into recession. As people who are working and buying groceries in this economy, you and I want the Fed to get these rate cuts just right. Ideally, the Fed's rate cuts will help stabilize inflation around 2% per year while maintaining a healthy jobs market. The Fed had confidence in cutting its key interest rate in September for two primary reasons. First, inflation continues to trend in the right direction. One of the Fed's preferred measures of inflation, the Personal Consumption Expenditures Price Index, climbed 2.2% over the past year. It's very close to the Fed's target of 2%. The second reason the Fed went forward with an interest rate cut in September was it wanted to support the jobs market. The pace of job creation for U.S. workers has been trending lower. The unemployment rate reached a low of 3.4% last year, but it has since climbed to 4.2%, and the Fed wants to support a healthy jobs market. I'll quote one more number, 3, as in U.S. gross domestic product, or GDP, rose at an annual rate of 3% in the second quarter. This was nearly double the GDP growth rate in the first quarter of the year. An increase in GDP means the U.S. economy is producing more goods and services. If we are producing more, we're collectively earning more income. That means workers and businesses will have more money to spend, and that's good for the economy. I mentioned the U.S. presidential election at the beginning. While many of us are focused on the November 5th election, most research generally indicates that while election years might be more volatile, over the long term, markets have performed about the same regardless of the party in office. As always, Wespath will continue to monitor the latest market movements and update you on the most important developments. We are here to help you, keep you informed, and help you achieve your long-term goals.